So when you're looking at diligence in oil and gas programs, you want to look at variations in programs, diversification. You want to look at the historical performance track record, and you want to look at structuring of fees and revenue and participation. So we kind of briefly talked about that before, but you want to look at, is the program going to have some operated projects in it, non-operated project? Is it going to have diversification in basins? Is it going to have, and what is the track record of either the sponsor or the operator? So those are critical. So the sponsor and the operator can be two different things. So Invito Energy Partners is a sponsor and an operator. So in many cases, you will just be, a lot of the oil and gas deals that are out there that are offered is really just, there's a sponsor and they're always participating in somebody else's project, which in and of itself doesn't make it a bad investment opportunity. It's just a different type of a deal, and you need to understand that. So if you're looking at a operated project or a non-operated project, you absolutely want to understand, how are the fees structured up front? How much promote is up front? How much specifically in your initial investment is going into the drilling of wells? So for example, if you're investing $1, is 20% of that going into the fees up front? Is 90% of it? How much of it is going in fees and how much of it is going to drill wells? So obviously the more fees that are up front, so for example, if you're investing $100 and only $80 or $80 is going into the ground, you have 20% in fees up front. It's going to make it much more difficult to perform on an oil and gas project. And then how much is the sponsor or the operator participating in the revenue, which is what I would call alignment. So obviously the success of oil and gas projects is tied to how well the wells perform. So you want to look at that revenue participation. So when you're looking at the management teams, you want to look at, again, how much diversification of experience within the management team, right? So are they, the best thing I can tell you here to ask is their background oil and gas, and is their background technical? So if their background is been in oil and gas, what size companies have they been in? Have they spent any time? Is there anybody on the executive team that spent time in the bigger, larger publicly traded companies? Have they been an operator? Have they only been participating in non-operated projects? So in and of itself, again, it doesn't mean a deal is not a good investment, but you want to understand the background of the team. You also want to understand management's balancing for opportunities, planning for rainy days. And really what I mean by this is, look, oil commodity prices are one of the most volatile commodities out there. And so you want to understand from your sponsor or your operator, let's say you enter an oil deal and all of a sudden oil drops to $40. Well, what is the plan to maintain performance during that time? So if you're aligned with the sponsor, aligned with the operator, and they have control of the project, then they have the ability to control the production. So that's one of the ways you can plan for, operating under, what I would call rainy days, which is really in oil and gas when commodity prices drop. So diligencing track record. So truly, past performance is, isn't indicative of a future result of an upside or downside. And that could be with the funds that they've in, the wells that they've drilled, or it could be with the prior companies that they've been in as well. So that's obviously critical to understand and look at the track record of the sponsor and the operator if they're different. So if it's a sponsor and it's only you're participating in non-operated projects, then you want to understand what is the track record of the sponsor, because the sponsor's job is to pick the oil and gas projects to participate in. It's their job to underwrite those projects. And then you want to understand the track record of the operator that is operating that well. So that's a critical thing to look at. And then the review of the current business model alongside management success and failures in prior projects. Engage forward-looking due diligence as future costs and performance matter. Really, you just want an eye to how does the management team look at changing environments, changing commodity prices, changing cost environments, and how do they manage to do that? All right, so when you're looking at different programs, you're looking at different oil and gas projects. you want to talk about, there's two different types of main oil and gas drilling projects that are out there. There's vertical and horizontal drilling. So vertical is traditional in oil and gas business, has been around for 100 years, and horizontal is what's really changed the oil and gas industry over the last 20 years with the new technology, new fracking technologies. And most of the horizontal drilling is done by larger operators, or it doesn't have to be larger operators, but if you're going to do horizontal drilling, you definitely have to have technical skill sets on your team. Horizontal wells cost more, they're more technical, they take more experience. But if you look at the top 10 publicly traded oil and gas companies, they're all engaging in horizontal drilling. And the reason for that is it's a more efficient use of capital. It doesn't mean that there aren't good vertical projects out there. It just means if you're looking at a horizontal project, which is what you will find most of the bigger oil companies engaging in, you want to make sure, once again, either your sponsor or your operator has the technical wherewithal and skill set to manage that kind of a project. The other types of nuances and programs is what's called conventional or unconventional drilling. Over the last 15 years, the advent of technology and what's called horizontal drilling and fracking technologies has allowed oil. The United States, if you look back 15 years ago, was about a $5 million a day producer in oil. Prior to COVID, we were the largest in the world, just under 14 million barrels a day. So what happened was the technology changes in the United States. So horizontal drilling and fracking technologies allowed us to go into old vertical fields where we know the oil is there, but we can use technologies like horizontal drilling and fracking, and we can get hydrocarbons that were inaccessible before, and we can now get access to those hydrocarbons and flow them up out of the wellbore. So that's been a huge game changer for the North American oil and gas industry. The unconventional are typically from a risk standpoint are much more risk adverse in terms of when you're going into an unconventional field, you have a good understanding of what's there because there's plenty of data to know that there's hydrocarbons under the ground. Conventional, there are a lot of different conventional type of drilling. Some of it can be trying to hit bright spots, 3D seismic, and some of those projects are hit or miss. I mean, it's kind of a binary option. You either have a great well or you have a dry hole. And so from a risk standpoint, unconventional has much more of a lesser risk profile. So geographic and geological diversifications, really you're just looking to see if you're in a fund, does the fund have diversification and what different basins you're in? So obviously diversification is always on its surface a good thing, but if you have diversification in basins, but the basins aren't good, that's obviously not going to be a benefit for the performance. And then you obviously want to understand the sponsor and the operator's experience in the region. That's critical to, doing due diligence on these projects.